Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, June 24, 2026. We're Elena and Marcus.
Right. And today we have a packed data deck to get through.
Indeed we do. Imagine borrowing $830 billion just to chase fractions of a penny, hoping the financial system doesn't experience a single hiccup.
Yeah, that massive, highly leveraged gamble is, just one of the systemic tail risks we're unpacking today.
Correct. We have been doing a deep dive into our daily desk data and crossing those internal updates with global institutional flows. And four massive themes really jumped out at us that set the foundation for this session.
Right. They are deeply intertwined. We are not looking at isolated asset class movements today.
No, not at all. First, we observed a sharp disinflationary impulse, driven by a severe commodity sell-off, specifically across oil and gold. Second, we're tracking a massive divergence in global rates. That's balancing a notable treasury rally against an overtly hawkish posture from the Federal Reserve.
And third, we saw highly bifurcated equity flows today, which was underscored by an after-hour surge in semiconductor stocks. That move completely reversed the intraday technology selling we tracked.
Understood. And finally, we must examine that systemic tail risk lurking in the background of all these moves, an $830 billion treasury basis trade.
When you examine our latest run of data, the overriding narrative is a market attempting to price in geopolitical de-escalation while simultaneously navigating extreme central bank uncertainty.
Moving to today's data, we really have to start with the biggest macro driver on our screens, which is the global rates complex. Domestically, the 10-year Treasury yield dropped 10.5 basis points, closing at 4.402%.
Right, and the 30-year yield moved in lockstep with that, dropping 10.6 basis points.
Exactly. However, the short end told a completely different story. The 2-year yield remained stubbornly anchored at 4.14%. And this price action occurred alongside Fed Chair Warsh, confirming a distinctly hawkish posture.
Yeah, by actively eliminating forward guidance, the Federal Reserve is injecting a severe uncertainty premium into the front end of the curve.
Correct. Applying our first principles rule for our listeners. With the 10-year dropping 10.5 basis points, while the 2-year remains anchored at 4.14%, how exactly does this steepening dynamic and Warsh's elimination of forward guidance impact the everyday portfolio?
Well, the mechanics here are critical. It creates a highly specific, bifurcated environment for everyday capital. When the Federal Reserve removes forward guidance, they are effectively telling the market that policy is entirely data-dependent, meeting by meeting.
Right, which leaves the market guessing to some extent.
Exactly. And the 2-year Treasury is highly sensitive to the immediate near-term path of the federal funds rate. Because Warsh is refusing to hold the market's hand or offer a predictable glide path, traders must mechanically price in the risk that rates stay elevated for much longer than initially modeled.
Therefore, the 2-year yield refuses to budge.
Right. Conversely, the 10-year and 30-year yields are driven by long-term growth and inflation expectations over the span of a decade. Today's severe commodity sell-off signaled impending disinflation.
It's understood. Which gave institutional buyers the confidence to bid up long-duration bonds.
Exactly, driving those long-term yields down. So on one hand, the falling long-term rates offer immediate, tangible relief for consumer financing tied to the long end.
Like mortgages, for example.
Right. Mortgage rates take their cue directly from the 10-year Treasury. That means prospective home buyers or large corporations issuing long-term 10-year corporate debt see an immediate reduction in their structural borrowing costs. That is the winning side of the equation.
Indeed. But on the flip side, the anchored 2-year yield means the cost of short-term capital remains highly restrictive.
Yeah. Think about credit card rates, auto loans, and the revolving credit facilities that small businesses rely on to make payroll. For an equity portfolio, this means companies reliant on short-term rolling debt will continue to suffer margin compression.
While those benefiting from long-term capital deployment receive a sudden tailwind.
Exactly.
On that point, we also saw this policy uncertainty ripple heavily into the international data deck. Today, European Central Bank member Schnabel stated that further rate hikes are strictly needed to reach their 2% inflation target.
And that hawkish rhetoric weighed heavily on European equities.
It did. The DAX closed down 0.62% and the MIB closed down 0.74%. Schnabel is widely considered the most hawkish voice on the ECB board, and her commentary today reinforced a structural headwind for European risk assets.
The European divergence is just a textbook example of central banks battling local macro constraints that differ entirely from the United States.
Right, because while the U.S. is seeing relief from commodity disinflation today, Europe remains highly sensitive to local wage growth.
Yeah, wage growth and structural labor rigidities. Schnabel is effectively closing the door on near-term European rate cuts. That immediately dampens the valuation multiples for the DAX and MIB because equity investors now have to discount future corporate earnings against a higher risk-free rate for a longer duration.
Understood. Furthermore, if we look back at the U.S. proprietary updates, the first quarter, current account deficit widened to negative $226.83 billion.
That is a significantly wider than expected print.
It is, which fundamentally acts as a structural negative driver for the U.S. dollar over a long time horizon.
Well, the current account is essentially the broadest measure of U.S. trade. It measures the balance of goods, services, net income, and direct transfers. When a deficit widens to a negative $226.83 billion magnitude,
It means the United States is importing significantly more capital to finance its internal consumption than it is exporting. Right.
exactly. Structurally, this requires foreign entities to hold vast amounts of U.S. dollars as IOUs. Over time, as that deficit grows, the sheer supply of dollars needed to balance the global ledger applies downward pressure on the currency's valuation.
So even though today's dollar index movement was dominated by short-term rate differentials, that massive current account deficit acts as a long-term gravitational pull.
Right, steadily eroding the structural purchasing power of the greenback.
Moving to today's data regarding equities. If long-term yields are falling to provide that borrowing relief you just mentioned, you would naturally expect equities to surge across the board.
Yep.
But looking at the broad indices, the S&P 500 actually finished down 9 basis points, closing at 7,358.
Yeah, the rate relief didn't exactly lift all boats.
No, but it is vital to note our desk data showed a $5.2 billion market on close imbalance to BUY. The NASDAQ 100 was down 43 basis points to 29,220. The Russell 2000 was up 9 basis points, and the Dow was up 36 basis points.
That $5.2 billion market on close, or MOC, imbalance is a crucial piece of market plumbing from our trading desks.
Because it's an aggregate of passive institutional flows, right?
Exactly. Think index funds and large ETFs that must mechanically match index weightings at the exact end of the trading day. An imbalance of that sheer size to the buy side indicates that despite the intraday choppiness and active manager selling risk, massive passive capital was mechanically forced into the market at 4:00 p.m. Eastern.
So this underlying bid often provides a structural floor for equities.
Right. Active managers might be de-risking based on headlines, but the passive machines are continually buying, which prevents a broader market breakdown.
Indeed. That dynamic was explicitly clear when we look at the real estate and home builder sector. Today's data deck showed that new home sales missed expectations by a wide margin, printing at 580,000 versus an expected 626,000.
Yeah, that is a 7.3% drop month over month.
Yet despite this fundamental miss in immediate demand, the home builders rallied aggressively. Polta Group, ticker PHM, was up 7.2%. D.R. Horton, ticker DHI, was up 6.7%, and Builders First Source, ticker BLDR, jumped 11.3%.
It seems completely counterintuitive at first glance.
Right. Looking at the home builders rallying on weak sales data, it's akin to celebrating a pay cut because it puts you in a lower tax bracket. The market decided that the drop in mortgage rates outweigh the actual demand miss.
That is a highly accurate way to frame it. This is a classic bad news is good news pricing dynamic in a highly rate-sensitive sector. As we discussed, the home builders trade inversely to the 10-year Treasury yield.
So when the 10-year yield dropped 10.5 basis points today, the algorithms just immediately priced in future mortgage rate relief.
Exactly. Investors entirely looked past the backward-looking sales miss. They calculated that lower structural borrowing costs will act as a massive stimulus for future demand, thereby improving homebuilder profit margins moving forward. The market does not care about what happened last month. It only cares about the liquidity environment over the next 6 to 12 months.
Understood. Moving to the financial sector, we saw all major U.S. banks pass the Federal Reserve stress test today. This resulted in immediate announcements of share buybacks and dividend boosts across the board.
But the reaction in the financial select sector SPDR fund, ticker XLF, was completely muted.
Correct. It closed down 0.3%. If passing the stress test is universally positive, why was the equity reaction virtually non-existent?
Well, the muted reaction in XLF perfectly demonstrates how ruthlessly efficient institutional pricing can be. I mean, the institutional consensus had already assigned a near 100% probability that the major systematically important banks would clear these specific stress test hurdles.
So the announced buybacks and dividend increases were entirely modeled into current equity valuations weeks ago.
Exactly. Furthermore, passing the test does not alter their strict capital requirement buffers for the current calendar year. Without a surprise reduction in required regulatory capital reserves, there was no incremental fundamental catalyst to drive the sector higher today.
The good news was already priced in, leaving financials vulnerable to broader market shock and rotational selling.
Right.
On that point, that brings us to the technology and semiconductor space, which experienced severe intraday volatility. Throughout the regular session, broad tech saw massive net selling from institutional desks. In fact, our data shows this was the largest information technology selling in 5 months.
The intraday selling in technology was just a textbook momentum unwind. Hedge funds and active managers were heavily concentrated in long technology positions heading into the week.
And when Warsh maintained his hawkish stance,
Right. Those managers executed disciplined risk reduction mandates. They locked in profits on their highest beta winners to reduce their overall gross exposure. It was a mechanical degrossing event.
so they were not selling because the companies are fundamentally broken.
No, they were selling to raise cash and reduce portfolio volatility.
Indeed. And that was proven the moment the closing bell rang. In after-hours trading, Micron, ticker MU, surged 14% after providing fourth quarter earnings per share guidance of $31. Additionally, Qualcomm, ticker QCOM, jumped 10% during its Investor Day presentation.
Those after-hours moves confirm that the artificial intelligence capital expenditure cycle remains the dominant fundamental force in this market. Micron's guidance of $31 per share completely shatters previous institutional consensus estimates.
It proves that the demand for high-bandwidth memory, which is the critical bottleneck component for AI data centers, is accelerating vastly faster than physical supply can accommodate.
Exactly. And Qualcomm's 10% surge similarly validates that AI processing is officially moving from centralized cloud data centers to edge devices, like mobile phones and laptops.
This creates an entirely new global hardware upgrade cycle.
Right. The intraday sellers were caught completely off guard by the sheer velocity of fundamental earnings power these specific semiconductor firms continue to generate.
On that point, we must connect these equity rotations and rate drops back to the underlying root cause observed in today's deep dive, the massive collapse in hard assets.
Yeah, the commodity moves were historic.
They were. WTI crude dropped 4.4%, which equates to down 437 basis points, closing at $70.01. Brent crude fell 5.0%. This deflationary impulse is being driven by a fragile U.S.-Iran truce, which is currently allowing the Strait of Hormuz to reopen to commercial shipping traffic.
The Strait of Hormuz is arguably the most critical oil transit choke point on the globe. When geopolitical tensions escalate in that specific region, the market mechanically prices in a severe risk premium.
Operating under the assumption that millions of barrels of daily supply could be taken offline instantly.
Exactly. So the U.S.-Iran truce effectively removes that worst-case scenario from the pricing models. A 5% drop in Brent crude is a massive macroeconomic event. It immediately lowers input costs for global manufacturers, it reduces transportation costs for logistics companies, and it acts as a direct, untaxed stimulus for the everyday consumer at the gas pump.
And this commodity collapse is the exact macroeconomic catalyst that gave the bond market permission to aggressively rally the 10-year Treasury today.
Right, you can't separate the two.
Understood. But alongside the energy collapse, we saw a historic movement in precious metals. Gold broke below the psychologically significant $4,000 per ounce mark for the first time since November. It closed at $3,994, down 304 basis points. Silver collapsed nearly 7%.
It was a brutal session for metals.
It was. But does gold breaching the $4,000 mark signal a structural abandonment of safe haven assets? Or is it simply a mechanical recoupling with a stronger dollar, given the DXY gained 18 basis points today?
Well, it is almost entirely a mechanical recoupling with real yields and dollar strength, which halts a 3-year structural bull market in the metal. The mechanics here are highly specific. Gold yields 0 interest.
Therefore, its primary competition for institutional capital is the real yield offered by U.S. Treasuries.
Right, which is the nominal yield minus the expected rate of inflation. Even though nominal long-term yields fell today, the collapse in global oil prices means inflation expectations fell vastly faster. Therefore, real yields remained highly restrictive.
Furthermore, commodities are priced globally in U.S. dollars. An 18 basis point gain in the DXY intrinsically makes gold more expensive for foreign buyers.
Exactly, structurally reducing aggregate demand. Once the geopolitical risk premium in the Middle East unwound today, the absolute urgency to hold non-yielding safe haven assets just evaporated.
And once it crossed that threshold, the machines took over.
Yeah, precisely. The algorithmic trading models that track the inverse relationship between the US dollar and gold executed massive sell programs the absolute second that $4,000 technical support level was breached.
Moving to today's data regarding the bigger picture, this brings us to the synthesis of our proprietary updates. We have to connect the dots across these asset classes to determine the broader economic regime we are entering. Our internal desk data just cut the U.S. recession risk probability from 25% down to 15%.
And concurrently, we nudged sequential second-half GDP growth forecasts up to 2%.
Correct. When you synthesize these data points across rates, equities, and commodities, what does the overarching regime look like?
It becomes pretty clear. We are currently operating in an environment of highly resilient domestic growth, temporarily shielded by massive disinflationary commodity shocks. The drop in oil prices provides critical immediate relief to corporate profit margins and consumer wallets.
Which directly justifies the upward revision in macroeconomic GDP growth.
Right. The underlying economy is fundamentally sound. However, the plumbing of the financial system is not without severe fragility.
And that fragility brings us back to the hidden fault line, identified as the top of our deep dive. The hedge fund basis trade in U.S. Treasuries has reached a massive $830 billion. That is twice the prior historical peak.
It's an immense figure.
It is. How exactly does a trade grow to almost $1 trillion in size, just exploiting tiny discrepancies?
The Treasury basis trade is arguably the most critical systemic risk lurking in the dark plumbing of the financial system today. The strategy itself is, relatively simple. Hedge funds buy cash, Treasury bonds, and simultaneously short Treasury futures contracts.
They are attempting to capture a microscopic pricing discrepancy between the two instruments.
Right. Because the price difference is literally a fraction of a single penny, funds must apply massive leverage to make the trade profitable. It is like picking up a single penny off the train tracks. But to make it worth your time, you borrow a massive forklift to pick up 50,000 pennies all at once.
The profit is virtually guaranteed until you hear the train coming.
Exactly. In this case, the forklift is the overnight repo market, where hedge funds routinely borrow 50 to 100 times their initial capital just to fund the position.
Correct. With $830 billion in leveraged Treasury positioning reliant on that overnight repo market, what specific metric should an investor monitor to spot a disorderly unwind before it hits the broader equity market?
You must vigilantly monitor overnight repo rates and the MOVE index, which measures structural Treasury market volatility. If Chairman Warsh's hawkish policy triggers a sudden, unexpected spike in front-end interest rates, the cost of borrowing in the repo market will surge overnight.
And if the cost to finance that leverage suddenly exceeds the tiny fraction of a penny profit margin of a basis trade,
then hedge funds will be forced to abruptly liquidate $830 billion of Treasury positions. This forced mechanical selling would cause immense volatility in bond yields, which would immediately cascade into a severe cross-asset sell-off in global equity markets.
Understood. As we look to Friday's PCE deflator, consider this. If commodity disinflation stalls, but the AI infrastructure spending seen in tonight's semiconductor earnings continues to demand massive capital, this delicate balance between hawkish rates and equity multiples will face its ultimate stress test. The market is pricing for perfection, but the leverage in the system leaves absolutely no room for error.
Right. To summarize today's briefing quickly, commodities crashed as geopolitical de-escalation removed the risk premium from oil, causing the yield curve to steepen as the long end rallied. And while technology equities saw heavy institutional selling intraday, massive after-hours earnings from the semiconductor space proved the AI capital cycle is still thoroughly dominating the tape.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.